Hey class, today we're going to take a look at Chapter 4, Accounting for Merchandising Operations. And in those operations, we're typically going to have a company who's going to sell a product which has a cost of goods sold associated with it. The difference between what it costs the company for that product and what they sell it for is going to be a gross profit. And there's other expenses that the company incurs before you get to net income. Now, when we're calculating how much that cost of good actually is, I think this inventory system is extremely important to keep in our minds, not just for this class and for these purposes, but it'll also be useful once we get to talking about inventory systems generally and LIFO and FIFO, as well as being applicable for managerial accounting. Generally, what we're talking about here is for something to be available for sale, it has to come from one of two places. Either we already have it or we have to get it. Here, having it is it coming from beginning inventory. Getting it is net purchases. And then the entirety is available for sale, and it's got to go to one of two places. Either we use it or we store it. You're storing it, is it ending up in ending inventory? And using it, is it becoming part of that cost of goods sold? Within inventory systems, there's also perpetual systems and periodic systems. Almost exclusively in our class, we're going to be focusing on perpetual systems, which once the underlying economic transaction occurs, we're going to be recording that transaction for a journal entry. But it is important to know that there is periodic systems, and essentially what they are is companies that may not report them immediately, but rather kind of save them up or store them up, and perhaps on the last day of the month or something like that, we'll go ahead and enter all those records. So looking at how purchases typically would work, and this is going to be without any cash discounts or anything like that, what we typically have seen is a debit to merchandising inventory and a credit to cash once we pay cash. Now, if we introduce a cash discount as something possible when we go to our suppliers, we're still going to debit merchandise inventory by the invoice amount because we don't know on the front end whether we take advantage of the discount or not. We're going to credit accounts payable by the full amount. But here we've got terms associated with this invoice of 210 net 30. What that's going to be is the 2 and 210 is a 2% discount if we pay within 10 days, and the net is going to be paying the balance or paying all that's due within 30 days. So here we're going to be able to receive that discount if we pay within the 10-day mark. Otherwise, the invoice is permitting us 30 days to pay the full balance. So here you can see just a timeline as far as when the invoice date is and then having that discount period. You have the choice to elect to pay within that discount period. If you're going to make that choice, often companies will do it very close to the actual last day of the discount period. And if not, we'll often pay at the very last point of the credit period to pay within the 30-day window. Now, how that's going to look if we do take advantage of the discount is we're still going to debit the full amount of the accounts payable because we're no longer going to owe our supplier that $500. We're going to credit the $490 in cash that we pay, representing that 2% discount. And then instead of the $500 net debit to merchandise inventory, we're going to credit $10 of that back off, representing that discount, to where only $490 is going to remain as our merchandise inventory asset that gets added to our balance sheet. Now, if we pay after the discount period, we're still going to debit the $500 for accounts payable, and we're going to credit cash, which is going to be the amount we paid. It's also important to note that even though we're looking at terms of 210 net 30 with this invoice, it's possible that a supplier may offer different terms, such as 310 or 315 for a 3% discount within 15 days. And instead of 30 days permitted, it may be 30 days, 60 days. So the amount of time we're looking at here is just for an example. We're also permitted some return and allowances. For example, if the merchandise we receive is defective or not what we actually wanted or ordered. So in this example, if we were to get a $30 debit memorandum for an allowance for defective merchandise, what that's going to be is if we had purchased the $500, we purchased it on credit, so we would pay at a later point, but we looked at the damages, and we said, this isn't worth the full $500 that we agreed to, this is damaged. In order, from an accounting standpoint, to show that $30 reduction in invoice price, we're going to debit the accounts payable by $30, reducing it to $470, and we're going to credit that merchandise inventory by 30, taking it from 500 to 470. Now, as far as the return goes, if we had purchased $250 with terms of 210 net 60, and then return $50 of the goods before paying the invoice, we're essentially going to perform the transaction for that $50 portion in reverse. So when we make the purchase, we're going to debit inventory by 250, credit accounts payable by 250. The return is just going to be debiting back the accounts payable, so we'll no longer owe the $50 of the 250, and crediting off the inventory, so we'll no longer have the $50 of the 250. And now it's important to note here that when we take advantage of that discount, we're looking just at the discount associated with the amount we decide to keep. So instead of multiplying 2% times the 250, we've only retained $200 worth of merchandise. So we'll take 200 multiplied by 2% to get $4, and then the cash payment is going to be $196. Now, when we are purchasing from a supplier and receive these terms, we'll receive terms of, say, 210 net 30. There'll also be shipping terms associated with that typically. It'll be FOB shipping point or FOB destination. FOB stands for free on board, and what we're doing here is declaring when ownership is going to transfer. So if we were making a shipment from San Francisco to St. Louis, and we had it as FOB San Francisco, then the buyer is going to be in charge of making sure that there's transportation associated with it. If there's insurance that is going to be covering the cargo in that, it's the buyer's responsibility to cover that. If it's FOB St. Louis, then the seller is going to have the expenses of the transportation all the way up to St. Louis, and would be responsible for insurance over that period of time as well. This cost, whether or not it's borne by the shipper or borne by the purchaser, is still going to get included into inventory, either directly if it's being shipped to the warehouse in St. Louis, or by the purchaser including the transportation costs and insurance costs into the merchandise inventory. We'll take a look here at here where the buyer is in charge of transportation and insurance, and the transportation charges they have here is $75. So we'd see a journal entry for increasing the merchandise inventory by that amount, by the $75, and then the cash paid for the freight. So it's a credit to cash of $75. Now, just as we looked at the perspective of a company making these purchases from a supplier, we're going to look at putting ourselves in the position of selling to a customer and offering these discount and allowances for and returns. As the seller, if we don't have these cash discounts in place and are selling on credit, typically what we'd see is a debit to accounts receivable for the full amount, which would have be payable within, say, 30 days, 60 days, 90 days, and we'd have a credit to sales. We'd also have a cost side journal entry, so we'd show the cost of goods sold as a debit, and then the merchandise inventory would get credited off the balance sheet. We may, as the seller, want to include these discounts to incentivize the customers to pay earlier and make us a little bit more assured that payment will come. So similarly, we might have a data invoice, a discount period of, say, 210 net 30, and giving them 2% discount if they pay within the 10 days. Otherwise, for the accounts receivable, asking that they pay the invoice within 30 days. Here, in this example, we've got terms of 210 net 45 associated with our purchases to us 2% discount, 10 days if paid within, or 2% discount if paid within the 10-day window. Otherwise, actually having 45 days to pay the invoice price. We're initially going to still set that set of journal entries up with the full amount of the invoice. So the accounts receivable will have a debit of $1,000. The sales will be credited of $1,000 because we don't know whether the customer will take advantage of the discount or not. And we'll have the cost of goods sold of $300 as a debit, and merchandise inventory credit of $300. Now, if the purchaser, the customer pays within the discount period, we're only going to receive $980. So what we're going to do is reflect a debit for that sales discount of $20 and credit off the accounts receivable for $1,000. This sales discount is going to get included as we calculate something referred to as net sales. So we'd have gross sales of $1,000, which is listed as our credit from November 12th. But we're also going to have a discount amount that's going to be a debit, reducing those gross sales to 980, and have 980 is what we would reflect and present as our net sales. Now, if the buyer pays after the discount period, they're not entitled to the discount. So similar to what we've seen before, we would just debit cash of $1,000 and credit accounts receivable for $1,000. Additionally, we might have sales returns and allowances. So if a customer returned merchandise which sold for $15 and cost $9, we're going to have two journal entries we need to account for here. The first is going to be the sales return allowance as a debit for $15, and then cash as a credit for $15. So we're not going to receive the $15 cash for that sale. So we're going to have, again, a debit listed here that would reduce the amount of net sales, and then we're going to return that cash and reflect that return by crediting cash by the amount. We're also going to have a cost side entry as well. So if the return can go back onto the warehouse, $9 was the value, we're going to credit the cost of goods sold by $9 either way. With goods that are able to be put back onto the warehouse shelf, we're going to debit that inventory back into our warehouse. So we're going to debit merchandise inventory by $9. However, if, say, $7 of that merchandise was defective and could not be resold, then we're going to take a loss for that. So we'll debit something called loss for defective merchandise as our debit, and then still crediting the cost of goods sold by that amount. We may also, if the item is found to be defective, the buyer wants to keep it, negotiate a reduction in price. So we may still take a sales allowance here of $10. This still reduces from those gross sales to net sales. It'll be a $10 reduction in our net sales amount based on that debit. We're also returning that cash to the customer. So we'll see a credit of $10 to cash, reflecting that it's being paid to that customer. So looking at a couple of the ratios we may want to take a look at. The first we're going to look at is going to be the acid test ratio. So this is going to be a measure of how quickly we would be able to pay off current liabilities. So one measure that is often looked at is taking current assets divided by current liabilities to see if those fairly liquid assets are sufficient enough to meet current liabilities, those liabilities that might come due within the year. The acid test ratio is going to be a little bit more stringent in terms of only looking at cash, short-term investments that could be converted quickly to cash, and receivables, like our accounts receivables, which we anticipate to be paid relatively soon, say within 30 days, 60 days, and then see how that measures up to those current liabilities that are due. One rule of thumb may be a value of 1, simply because we'd have the sufficient capital or sufficient assets to pay and meet those current liability needs if need be. But often companies will still go ahead and forward with their operations with an amount lower than 1. As we hold, as a company, more and more cash and short-term investments and receivables, and if we're holding them simply to meet current liabilities, when in effect those current liability needs may not come due, there's concern about that creating inefficiencies in operations. So some companies elect to actually exist and operate below that level of 1. So looking here as an example, one thing we could do, as we've seen before, is not knowing whether our ratio is going to be a good ratio or a bad ratio in a vacuum. You want to look at another competitor. Here we've got an acid test ratio by Nike, and we can compare it to Under Armour and know that we are more conservative and more in a position to meet those needs than Under Armour is, with 1.8 compared to 0.9. And we can also look back in time to see if we've gotten more conservative or more risky over time. Here, looking back 2 years at 1.5, 1 year at 1.6, now 1.8, we can say we've gotten more conservative over that span of time. So it lets us know a little bit of the direction and lets us know a little bit of the comps in terms of how that ratio stacks up. Another thing we might look at just for comparison's sake is the asset test ratio against the current ratio. The current ratio is going to include all of those current assets, not just the assets included in the asset test ratio. So here with a 1.8 for the asset test ratio, the current ratio is about 2.9, so having about almost 3 times the amount of current assets to meet those current liabilities. So another ratio to look at is going to be the gross margin ratio. So similar to profit margin ratio, this is going to give us a percentage of dollar sales that's going to be available to cover expenses as well as go towards that net income, go towards that profit. The way we're going to calculate that is net sales, which is going to be our gross sales less discounts, returns, allowances to get to net sales. And we're also going to subtract off the cost of goods sold. So we're going to end up with a gross profit on the numerator. And then we're going to divide that amount by net sales, which is going to be, again, our gross sales minus discounts, returns, and allowances. And it'll give us a percentage of that that's able to go towards covering other expenses and will ultimately contribute to the net income or profit. Here you can see in this example that our company has decreased from about 46% 2 years ago and a year ago to 44.6% in the current year. So we can see there's a little bit of margin compression that's existing here. And that's going to conclude the lecture of Chapter 4.